When we come back, Peter Grandich, the Grandich letter, I should say, raised red flags for the markets today. We will identify what those are right after this. All right, we're back with a little more context on those Nortel comments.
I mean, Nortel just agreed to pay $35 million to settle yet another action by the SEC. And we reported that one of the commissioners, Paul Atkins, was critical of this, saying shareholders are going to have to pay. The settlement doesn't further the interests of the SEC. Of course, Atkins has done this before. He's an appointee by President Bush, and he's criticised the SEC in the past for going after hedge funds for extracting big fines. So he's apparently a confirmed libertarian, and he wants a softly approach to regulation.
All right. Context, good context to have. One thing we mentioned, we've got Peter Grandich coming up. Before we actually talk to him, this is a letter that came out today, complete with all my highlights on it. But take a look at some of the headlines that he talked about within this. Essentially, it's an extraordinarily bearish letter. And what he says it is, what I'm going to write is not pretty. In fact, it's downright scary. He goes on to say that he has never been as bearish on the markets that he's ever been in his entire career. So there are two factors that lead me to the most bearish stance I've ever taken in my entire career: the aging crisis and geopolitical time bombs. Now, in terms of why he's bearish, there's a lot of things. He gives a lot of context as to why. There's nothing specific and new, except perhaps it's more extreme than it's ever been before. And there's a few little time bombs he does see setting things off. Why you should listen, and we'll talk to him about this in a second. He said back in August of '87, he wrote about an expectation of a market crash within weeks in August of '87. And if we all know, we're coming up on a 10-year anniversary of the big crash that did happen in '87.
More than 20% in one day.
Yeah. So he got it right last time. And he thinks that he's more scared now than he was last time.
He's coming up. It's interesting. He's very worried about the aging of society. And the first baby boomer in America claimed her Social Security today.
Yeah, so there's some timing for you. Yeah. As soon as we come back from this break, Peter Grandich, editor and publisher of the Grandich Letter, will be here on the phone from New York. We'll speak to him about his very bearish comments. Welcome back to After Hours. I'm Kim Parley.
I'm Andrew Bell.
Coming up in the next half hour, as we've been mentioning, we're talking to Peter Grandich. He is, of course, of the Grandich newsletter, and extraordinarily bearish in the markets right now. We'll talk about that and why. Also, you're going to be talking to Michael Miller.
Michael Miller, lawyer with Steptoe and Johnson. When does the agony end for Nortel shareholders? I mean, they paid out more than $2 billion to settle investor lawsuits, but the SEC apparently still not done with the company, not to mention former executives.
And then, of course, Michael Gregory from BMO Capital talking about the Bank of Canada and what he is expecting to be a very interesting decision, especially given the context that will be coming out in the statement. Economists are basically split right now in terms of what the decision will be as they move ahead. Now, as promised, joining us now on the phone with his ultra-bearish views on equities is Peter Grandich. He's the editor and publisher of the Grandich Letter, and he joins us from New Jersey. Peter, can you hear us?
Yes, Andy and Kim, thank you for having me.
It's a pleasure having you on, Peter. Let's just start at the beginning on this letter. What prompted you to write this?
Well, for quite some time I have written to my readers that until the Federal Reserve would go into an easing mode, I didn't think that the U.S. stock market could top out, but it would be the last silver bullet that they would be able to be used. In addition, the credit crisis, which just was 8 weeks ago, has seemingly been viewed by the people on Wall Street, the very people who put the packages together that got us in trouble, are now saying that it's over, when realistically those who know it best, some of the founding fathers of credit derivatives, are warning that the national anthem hasn't even been sung. And then geopolitical concerns of mine, particularly in the Middle East, and particularly what's happening not so much in Iraq but with Iran and Syria, all have combined with an economic belief as head of the person that knows best in the United States of what kind of fiscal shape we are is the control of the currency. And David Walker has become alarming about what fiscal mismanagement has happened on a government level. So all these things combined, plus some technical work, suggested to me, not so much for the next week, month, or year, but for the next foreseeable future, if not the next generation, things are going to be pretty tough, at least in the U.S. market.
Now, just to be clear here, Peter, you say in the letter that I know that you wrote when you were working for a firm back in 1987, you wrote some analysis that basically predicted what was going to happen in October, and you got it right, so which is perhaps the reason why we're looking at this right now. Is it true to say you've never been more bearish than you are right now?
Yeah, only because I believe the United States is in far worse economic and geopolitical shape than it was in '87. So that's why, while I don't think it's going to be a crash because certain safeguards that weren't in place are now, that should prevent a 20% down day. But nevertheless, I think over the longer term, we'll see declines much worse than that. My simplest way of putting this, because I know we're short for time, is I like to describe it this way. America has been robbing Peter to pay Paul, but Peter's tapped out. And really what kept the economy going was the ability of real estate going higher and cheap mortgages. When you take that out of the equations of the last 3 years, we would have had negative GDP growth. We know that's not going to happen. We may or may not have a further credit crisis, but we know there aren't going to be cheap mortgages, and real estate shouldn't be rising anytime soon. Without that, we're going to see a recession in the United States.
Peter, very briefly, give us a couple of securities people should buy right now. Well,
I'd sooner say that people be 100% cash than 100% stocks. I've confined my interest into gold and uranium, one, because gold is going to be more of a monetary factor, and uranium is simply because of the energy needs. So I would say that if you're going to err and be a live chicken versus a dead duck like I'm planning on being, I'd rather have a bigger cash position and own very little stocks.
Are you shorting the market at all right now?
I am, but that's a very dangerous thing that most people shouldn't do. If you're willing to lose part or all, even more of your capital than you have, then that's something you consider. But by and large, I think this is a good time, especially what you felt 2 months ago when you thought you missed it and were caught too long. Now's a good time to use this last rally as an opportunity to get much lower exposure in the U.S. market. I don't think Canada and I don't think the world will be as bad, but when we eventually get a big cold, you actually sneeze. So unfortunately, we're going to have to affect you as well.
Peter, a pleasure. Thanks so much for joining us.
Thank you.
Thanks, Peter.
Peter Grandich, editor and publisher of the Grandich Letter, on the phone from New Jersey.